The stock market is a wild ride. It's full of ups and downs, with prices constantly changing. Sometimes it feels like a roller coaster with thrilling highs and nerve-wracking lows. But savvy investors know how to handle the drops. They see opportunities where others see risk. They buy the dip. This strategy involves purchasing an asset when its price drops. Buying the dip means purchasing an asset when its price drops. It's a simple concept, but it requires a strategic mindset. But it takes guts to execute. You need to have confidence in your decisions. You need to believe in the long-term prospects of the asset. This means doing your homework and understanding the fundamentals. And you need to have the stomach for volatility. The market can be unpredictable and prices can swing wildly. Think of it like this: you see your favorite pair of jeans on sale. They're 20% off. It's a great deal, right? Do you hesitate? No. You buy them up. It's a steal. You know the value of those jeans and you're getting them at a discount. Buying the dip is similar. You're getting a discount on an asset you believe in. But it's not just about the discount. Remember, the market doesn't always bounce back. There are risks involved. That's why it's essential to do your research. You need to understand the market conditions and the reasons behind the dip. Understand the company or asset you're investing in. Look at its financial health, market position, and future prospects. Make sure the dip is temporary, not a sign of bigger problems. A well-informed decision can lead to significant gains. Before we continue, if you like this video, please remember to share it with your friends. Hit the like button, subscribe to the channel, and then watch some more of our videos. Buying the dip isn't a one-size-fits-all strategy. There are different approaches depending on your investment goals and risk tolerance. Long-term investors, like Warren Buffett, look for significant dips in high-quality companies. They hold these investments for years, even decades. They're not fazed by short-term fluctuations. They know the market always recovers eventually. Short-term traders, on the other hand, are more like day trippers at the amusement park. They're looking for quick thrills and profits. They buy the dip on assets with high volatility, aiming to sell quickly when the price rebounds. Some traders use technical analysis to identify buying opportunities. They look for chart patterns and indicators that suggest a dip is bottoming out. Others rely on fundamental analysis, examining a company's financial health and future prospects. Why do investors love to buy the dip? Because it offers the potential for significant returns. When you buy an asset at a discount, your potential profit margin increases. Imagine you buy a stock for $50. It drops to $40. You buy more. Now, you have a lower average cost per share. When the stock recovers to $60, you make a larger profit than if you had only bought at $50. Buying the dip can also help you build a larger position in an asset you believe in. By consistently buying during dips, you accumulate more shares over time. This amplifies your returns when the asset appreciates in value. But remember, buying the dip is not a guaranteed path to riches. It's a strategy that requires patience, discipline, and a bit of luck. Section 4. Navigating the pitfalls, risks to keep in mind. Investing in the stock market can be a rewarding endeavor, but it's crucial to be aware of the potential risks involved. Buying the dip sounds simple enough, right? The idea is to purchase stocks when their prices are low, anticipating that they will rise again, but it's not without risks. The market can be unpredictable, and what seems like a good opportunity can quickly turn into a financial setback. The biggest danger is catching a falling knife. This metaphor describes the peril of buying an asset that continues to decline, leading to significant losses. This means buying an asset that continues to decline, resulting in losses. It's a common pitfall for those who act too hastily without proper analysis. How can you avoid this? The key is to conduct thorough research and understand the underlying reasons for the dip. By thoroughly researching the asset and understanding the reason for the dip, you can make more informed decisions. Look at the company's fundamentals, market conditions, and broader economic indicators. Is it a temporary blip due to market sentiment? Sometimes external factors like political events or economic news can cause short-term fluctuations. Or is it a sign of fundamental problems within the company or sector? Issues like poor management, declining sales, or industry downturns can indicate deeper problems. Another risk is timing the market incorrectly. Trying to predict the perfect moment to buy or sell can be incredibly challenging. Even experienced investors struggle to consistently predict market movements. The market is influenced by countless variables, making precise timing nearly impossible. Buying too early can lead to missed opportunities. If you jump in too soon, you might miss out on further declines that could offer better entry points. Buying too late can result in buying at inflated prices. Waiting too long might mean you end up purchasing at a peak, reducing potential gains. Remember, diversification is key. Don't put all your eggs in one basket. Spreading your investments helps to mitigate risk. Spread your investments across different asset classes, sectors, and geographies to mitigate risk. Diversification can help protect your portfolio from significant losses in any one area. Section 5. Mastering the Dip Practical Tips for Smart Investing. In this section, we will delve into the strategies that can help you navigate the complexities of buying the dip effectively. Want to master the art of buying the dip? It's a skill that can significantly enhance your investment returns if done correctly. Here are some practical tips to guide you through this process and help you make informed decisions. 1. Do your homework. Research the asset thoroughly. This means diving deep into the company's financials, understanding its business model, and evaluating its competitive position in the market. Understand its fundamentals, historical performance, and future prospects. Look at past performance to gauge how it might perform in the future. Don't buy on hype or emotion. Emotional decisions can lead to significant losses. 2. Set clear entry and exit points. Determine your buy and sell targets beforehand. This strategy helps you stay focused and avoid making rash decisions. This helps you avoid impulsive decisions based on market swings. Having a plan in place can keep you grounded during volatile times. 3. Start small, scale gradually. Don't go all in at once. This approach minimizes risk and allows you to adjust your strategy as the market evolves. Start with a small investment and gradually increase your position as the asset dips further, if it aligns with your strategy. This way you can take advantage of lower prices without exposing yourself to too much risk. 4. Be patient and disciplined. Don't chase quick profits. The market often rewards those who are patient and stick to their long-term plans. Stick to your plan and be patient. Avoid the temptation to make hasty decisions based on short-term market movements. The market may take time to recover. Understanding this can help you stay calm and focused on your long-term goals. 5. Don't be afraid to miss out. Not every dip is worth buying. Sometimes it's better to wait for a more favorable opportunity. If you're unsure, it's better to sit on the sidelines and wait for a more compelling opportunity. Patience and careful analysis are key to successful investing. Section 6. Is buying the dip right for you? Buying the dip can be a profitable strategy, but it's not for everyone. It requires a certain level of risk tolerance, patience, and market knowledge. If you're easily spooked by market volatility or need access to your money in the short term, this strategy might not be suitable. It's essential to align your investment approach with your financial goals and risk appetite. Consider your investment horizon. Are you investing for retirement in 20 years? Or are you saving for a down payment on a house in 5 years? Your time horizon influences your ability to withstand market fluctuations. Remember, there's no shame in seeking professional financial advice. A qualified advisor can help you develop a personalized investment plan that aligns with your individual circumstances. Section 7. The final word, a strategy for the ages? Buying the dip is a time-tested strategy that has proven successful for many investors. But it's not a magic formula for instant riches. It requires careful planning, research, and discipline. As the market evolves, so too must the strategies we employ. While buying the dip remains a potent tool in the investor's arsenal, its success hinges on adapting to the ever-changing landscape of the financial world. Remember, the key to successful investing lies not in predicting the future, but in responding intelligently to the present. So, stay informed, stay agile, and never stop learning. If you like this video, please share it with your friends, hit the like button, subscribe to the channel, and watch more of our great videos. Thanks for watching! Disclaimer: I am not a financial advisor. I do not provide investment, tax, legal, or accounting advice. This material has been prepared for entertainment purposes only, and is not intended to provide, and should not be relied on for investment, tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction.